All right, let's answer some questions from the last market outlook. And there were a lot of them this time, and a lot centered on the thesis that I had put forward about the excess retirements. So I'll spend some time on that. So I don't know if I'll get through all the questions, but I'll try to get through as many as I can. And in behind me, I hear somebody opening the door, and in they come with a big bowl of cherries. Look at that. It is my day. Let's begin. Okay, the first comment is just a comment. Second comment is just a comment. Living in Southern California, I can sympathize with you. Yeah, for fires, most definitely. I've been debating with myself for the past few years, but couldn't settle my own debate. I'm rapidly approaching 40 with children under 5 and a demanding job. So I'm short time. It reminds me of that song Cats in the Cradle, and children and a demanding job. If you haven't heard that one, Harry Chapin, Cats in the Cradle, have a listen to it. I mean, wow, at the end of it doesn't choke you up. So I'm short time. Eye bags, despite all the knowledge I gained through my CFA journey, I can't resort myself to actively managing a large portion of my own portfolio, and the portion that's active desperately needs analytical love. Is there anything I'm missing in the active management realm that could be accomplished with limited time to analyze and most assets and registered accounts? No. With limited time, no, because you really have to look at the cost of actively managing a portfolio, and I'm slowly approaching that point as well with the applied series growing the way it is. I know that my time is better spent on that. It's just that we have such active markets right now. It's hard to just ignore the screen. But there's a cost to actively managing your own portfolio. So you have to take the active versus the passive. And think about, well, if I did a general 60-40, I mean, you could do this yourself, 60 in SPY, 40 in TLT, and there you go. You got a 60-40 portfolio that probably has a combined yield of right now 2.5%, a yield of 2%. And if you have 30 years, SPY in 30 years will be higher. It will be higher. TLT at some point will be higher because bond yields are going to have to go down. At some point there'll be a recession. That's just the history of capitalism, because you always get overinvestment in a sector and then you get corrections in the economy. Sort of model out what that can do if you take the past 50 years as an example, or past 40 years, model that out and ask yourself, how much more can active do, or how much more you can do with active? How much time will that require, and is that time got a better return doing something else? And if you listen to Cats in the Cradle, the better return you have is with your kids. Almost every end-of-life study that's looked at in terms of regrets is always in terms of relationships lost, in terms of relationships not invested in properly, not in terms of I didn't outperform the market by enough, or I regret not spending more weekends at the office. So this is sort of, you say kids under 5 and a demanding job. You have to think about it in that particular respect. Not only that, there is no fault in being hesitant about managing assets. It is a different psychology that you need when you manage assets versus when you're just researching. In fact, there is a good argument that says you cannot possibly be a good researcher if you have money on the line, because you will be biased. It will bias you, and you will try to argue the point that works for you the most. And this is why we have disclosures, analyst disclosures of whether they have positions in a stock or not, because we should be able to judge whether the research is biased. So having the CFA charter, there are two sides to that. There's asset management, and there is research. And you could probably be a better researcher unburdened by the emotions of money. So if you don't have the wherewithal or the time for it, throw yourself into research and ask yourself, could your career progress better by focusing on what your career is? Would your relationships be stronger by spending more time there? And the incremental amount you would make in active versus passive, if you don't have the time or the psychology for it right now, is it worth it, right? Let's see. Interesting in being the star of so much of your video this week. Retired 11 months ago, 59. Pretty well nailed my thought process on it. Only major difference is I haven't yet locked in my interest rates, as I think we'll get another 100 basis points increase from the Fed over the next 6 to 9 months. So don't take your chances, right? What if you don't get it? What if the economy breaks and the Fed lowers rates dramatically very quickly? What if Russia deploys battlefield nukes and markets just take a plunge and money rushes into bonds and interest rates? The market just cuts interest rates even before the Fed cuts interest rates. When you think you like something or you want to move into something, take a third position. Take a third of your position. You're never going to pick a top. You're never going to pick a bottom. What you hope is to sort of build into a position that you're comfortable with over time. So maybe you want to take a third position where you have your duration and you have 2/3 maybe in the 3 month to 6 month cash range, which has a nice yield. And then 2 months later or 3 months later, when some of those mature, maybe you move a little bit over to long duration. What you don't want to miss in the long duration is locking in the yield and securing that big fat capital gain when, and it is inevitable, look at history. There is a business cycle. It is inevitable that we will have a downturn, and it is inevitable that we will have some significant one at some point that causes the Fed to cut rates. When? Who knows? Who knows? That's the random part of it, right? So you can follow the old adage. What you're trying to do is time the market. Instead of timing the market, try time in the market, right? Because it is those random days that if you miss those, you miss the big move. So maybe reflect on, your waiting and think about stepping into some of it. After a few months, I think we finally came out with a good story that fit the data, and I agree with it. Maybe the way out is to run into the fire, but when the market is selling, hope neither of us win the 55. Yeah, no kidding, eh? I hope I don't win that lottery. No, but the universe has to believe it, and I'm not a very good actor. I have to be believable to the universe, and if I don't want something, I will most likely get it. You just described exactly what I'm doing. The Fed will never run into the fire because they fear inflation too much and there's too much debt they need to auction. Well, the Treasury holds the auction, right? The Fed really doesn't have a big role in the level of the debt. They own some of the debt, but they have no say in where the debt is going. Really, that is the fiscal. I'm waiting for 30-year, 5+. 5+ to lock in. That's 100 basis points on the 30. You would have to have a Fed to get that on a 30-year. That's not the Fed raising rates. The Fed raising rates even higher would probably push the 30-year down, the 30-year yield down, or at least cap the 30-year here. To get the 30 to 5, inflation expectations would have to become unanchored, which means the Fed pauses even though inflation is clearly running higher and higher each month. The Fed decides to do nothing about it, or even cuts to stimulate the economy when it's already overheating. Then inflation expectations will be built into the 30-year. The 30-year does not reflect monetary policy. It reflects the trend of GDP growth, and it reflects inflation expectations. So you want a 30-year at 5%. This has to increase significantly. The Fed is not going to do that. The more it raises the money market rates, here is your yield curve right now. There's the inversion. Here are your money market rates up to the 1 year. Here's your capital market rates. The more it raises money market rates, I think the deeper the inversion you're going to get, because the belief is that you will kill GDP, and of course nothing kills inflation expectations like killing GDP, right? Don't know about that 5%. Let's see. Great explanation connection between low labor force participation and this trend for early retirement. This is something I've been thinking about a lot. The printing is rather small on here, right? Let me see if I can do something here. Oh, that's a little too much. Let's lower that. There we go. How does that look? That's a little bit better, right? Great explanation and connection between low labor force participation rate and this trend for early retirement. Something I've been thinking about a lot, and come away with the complete opposite conclusions. Most pre-retiree portfolios held a heavier allocation into fixed income entering 2022 as investors tend to increase exposure to fixed income as they approach retirement. As you know, fixed income portfolios got absolutely crushed in 2022. Well, this is true. So yes, that person would be able to lock in a higher yield with the assets he holds now, but with much less asset level as a bond portfolio has yet to recover from last year. I see your point here. The paper made a pretty important point about the subgroups. When it looked at the subgroups, it said it is mostly college educated, mostly educated ones. When you look at companies, there are two types of pensions. There's defined contribution and there's defined benefit. Defined benefit used to be pretty common 30, 40 years ago. It's sort of fading away. Defined contribution tends to be the more common one. So yes, your argument for defined contribution would be true. Most of the people in defined contribution funds would probably be in some kind of target date fund, the target date being their retirement. And if we look at the mix between equities and bonds, it has sort of a glide path like this. So they're 30, 35, 40, 45, 50, they would glide more towards bonds. This is very common for blue collar. However, for management, it is still very common to have defined benefit because it is a retention technique that management or white collar still has defined benefit. And with defined benefit, your benefit is defined. So it is the asset mix is not your problem. And if you take an early retirement, you can take something called I think I'm spelling it right, commuted. Maybe there's one M and two T's. You know, whenever words have two M's and a T or one M and two T's, for some reason I just can't get it. Take the commuted value, and that's a buyout. And it is beneficial for the sponsor of the plan because then they don't have any longevity risk associated with you. However, your commuted value is based on a formula, not the value of the assets. So for the defined benefit, you don't take a hit. You get your commuted value, and if you're taking early retirement, you get to walk away. And you then can move all of that into fixed income. When you do retire, you for most defined benefit plans, there's either a 6-month or a 2-year window where you have to wait 6 months or 2 years when you can request that you do not want the benefit paid to you over time, that you'd rather have the value of it today, and then you'll go on your merry way, and then the pension fund is done with you. When you're bought out early, you're usually given a buyout and then some enhancement to sort of, usher you out the door, and off you go. So this is why for voluntary retirements you see those extra costs, because any shortfall from the pension assets has to be met right then and there. And so the companies incur an extra cost. So you get to walk with whatever you have. Not only that, this is your retirement. It is quite common especially for educated workers, white-collar workers, that as you're approaching retirement, you're 55, 56, that you're going to have your retirement accounts maxed out, plus you also have your taxable accounts as well. And if your retirement, if you had a defined benefit plan and you took a holistic view of your assets as opposed to the mental accounting view where you have different allocations in each portfolio without considering the whole. But if you took a holistic view, and you said, well, my defined benefit is truly bond-like, you probably were more equity-like in your taxable portfolio. Yeah, you probably have taken a hit, but if you have defined benefit, you're okay. You can take that commuted value, you can take that buyout, and off you go. Now, keep in mind there, the early retirements that companies are now using come with buyouts and enhancements to that commuted value. So you are probably made whole, if not a little bit more. So I think that answers a lot of sort of good objections to the argument that, well, yeah, sure, you can lock that in, but you have a lower asset value to lock that in. It's possible, but it's more likely when GM used, for example, when it used voluntary layoffs, it was laying off salaried workers, not union workers. They were laying off the salaried workers, and their defined benefit plan is now locked. It's all defined contribution. At least I think it's all defined contribution now. Their defined benefit, I think, got locked in 2008. And most companies now with workers are all defined contribution. Defined benefit is still a luxury for salaried workers, for office workers. Let's see. In your portfolio management for retail investors video, you mentioned two things. Young people should probably emphasize growth over income. Yep. To avoid good days and bad days, you don't look at the value of your account, but the income it generates. What indicators can someone with a goal of portfolio growth focus on to avoid the good? And, it has no show me more, so it just sort of ends there. And I get a couple of that just sort of end there, and there's no show me more on this one. I think what happened is when I expanded the printing, it got rid of that. So let me pause the video here. Let me refresh this page. Let me re-expand all of the comment sections, and we'll pick up right where we left off here. Okay, that did it. Looks like we've uncovered a bug in YouTube. Let's see. What indicators can someone with the goal of portfolio growth focus on to avoid the good days and bad days, given that their portfolio isn't generating income? Well, I don't think you want to avoid the good days. I'm not sure I follow the question overall. To avoid good days and bad days, you don't look at the value of account. Yeah, I'm not sure I understand exactly what it is that you're asking. And I'm not sure I said avoiding good days, so I'm going to take a pass on this one. Read an interesting article this week along the lines of your labor market theory. It argued that there's a tipping point where higher rates become inflationary. Higher rates are negatively affecting smaller businesses with short-term credit, while large corporations have access to cheaper bond market credit. This is true. This limits the slowing of the economy. Also, higher rates in bonds attract money from high net worth individuals and retirees, thereby functioning as QE, massively increasing the treasury debt expense at the same time. I'll post a link if I can remember what the hell I read. Well, this is true that if you push rates high enough and you don't break the economy, financing costs go up for everyone, and companies are profit motivated, which means they're going to try to preserve their margins as best they can. If they can't raise prices, they'll cut somewhere. And that's pretty much the limits of how high interest rates can cause inflation. Is once they start cutting, it takes away aggregate demand. However, combine that with cutting by pushing people into retirement as opposed to laying off people and creating a tighter and tighter labor market. There you have something called a price wage spiral. Where the labor market participation rate gets smaller, but the demand for labor doesn't decrease. Wages have to go up, so prices have to go up, so interest rates go up, which people who have debt feel that suddenly you paid me more, but now I'm broke again because rates are going higher. I need more money. They raise the prices, and I don't know that higher rates are inflationary as much as you could fall into a wage price spiral trap. That's hard to break without a price control. So it could be just the spurious correlation saying, well, if you push rates high enough, you will actually cause inflation. It's that if you push rates high enough combined with something else that keeps a labor market tight. So there's a conditional in there. And I would put that conditional in, combined with something else that keeps the labor market tight, you could get a wage price spiral, which then becomes very difficult to break. And I have given the theory before that perhaps it was not Volcker that tamed inflation in the early 80s. Perhaps it was Reagan's supply-side economics that actually broke inflation in the early 80s, because there were a number of economic innovations at the time which encouraged investment in new sectors. For example, pension funds were now available to invest in venture capital. Prior to that point in time, they were restricted from that. But I think it was 82 where they could invest up to 5% of their assets in venture capital. So there were a number of innovations like that, economic and financial innovations at the time, that increased the supply of investment in the economy. It could just be that we had high interest rates at the same time that the problem was being solved with a real economic solution instead of a financial solution. So it just could be that Volcker happened to be doing his thing while the solution was happening, thereby making it him look like it was the solution. But my argument for inflation now, you want to solve inflation, supply side. Increase the supply of labor dramatically, which will decrease wages, increase the supply of new businesses. Maybe you have a business development bank that offers way low interest rates. I was going to say way below something, but I ended up with way low interest rates, which sounds like a Chinese interest rate, right? Way low. But you know what I'm saying is if you can increase the supply in the economy, you reduce inflationary pressures. Correct me if I'm wrong, but wouldn't we factor out Q2 2023 and now start to include Q2 2024 in the forward EPS numbers, since we are done with the second quarter? On a calendar basis, we are done with the second quarter, but we have not seen the second quarter earnings yet. However, you have a point. Once we get a look at the first numbers coming in for Q2 this week, next week I do have to fall forward by 1 quarter, which will raise the forward 4-quarter earnings. And I think even using the forward 4 quarters by jumping to Q2 2024, we're still at 19.1 times forward earnings. And I think I read from IBES the 30-year forward PE is like 15.6. The 10 years at 16.5. So even at 19.1, we are elevated from the long-term average. And I've made this argument before, that if you have a mean reverting level on a PE, that it cycles around that mean reverting level where you're above the mean reverting level or below, and we say this is 16.6, which I've used before. It is okay to be at 19, but you have to ask yourself, are we in an economic backdrop that justifies a multiple that is higher than the mean reverting level? Usually, if you have rates that are coming down, if you have high unemployment that is dropping, in other words, aggregate incomes are increasing at a rapid pace, credit is expanding, then yes. But when you have rates that are increasing, a money supply that is decreasing, credit that is tightening, and a super tight labor market, it's hard to see how you can have a multiple, a forward multiple, that is above the mean reverting level. I've noticed the spread between EFFR and the one-day SOFR is rising slightly. Is this a result of T-bill issuance with the balance sheet runoff? I don't think so. SOFR is a secured overnight lending rate. It's secured. So I don't think it is the yield on the security that matters so much as the quality of the security, which is usually a T-bill or some treasury or some government security that is backing it. It could be that the effective federal funds rate is going to hold pretty flat, 5.08, until rates change. It could be that SOFR is beginning to reflect higher rates. It could be that a 1 or 2 basis points difference are creeping in there because of that. Even though it's one day, it seems like why would it begin to do that? But the effective federal funds rate is not a money market rate, right? It's an overnight rate. It's the Fed's overnight rate, whereas SOFR is basically a tradable rate in the market, an interbank rate. I don't know. I don't know enough about deviations from those to have much of a comment on that. The spike in real yields is largely due to the increase in nominal yields. Pretty much right now, yeah, because break-even seem to be well behaved. With regard to bear steepening, is this largely due to institutions reducing duration exposure? If so, where are they parking their money? I don't know that you would decrease exposure. You can have yields rising, I think, with just a lack of selling. So I'm holding a bunch of 30-year bonds. I'm not a seller. So there's no activity there. Yeah, you could just get there on just lower volume. I don't know that anyone's moving out of duration. It could just be reduced demand that is doing it. That bids are just going lower. That if I want to bid, I'm not bidding at on the 30-year. I'm not going to bid 3.9%. I want to see 3.95 or 4. I'll just move my bids, right? So it just could be that. Let's see, voluntary retirement. Let me get rid of that menu at the bottom of the screen there. Why is it beneficial for a company to approve voluntary retirement than just laying off the employees? A number of reasons. Number one is the delta between the more experienced and longer tenured employee versus the new employee. So if we take a timeline, let's say age 30 and let's say age 65, 35-year tenure, and you have somebody at let's say 55, and you're hiring somebody at 30, you're going to pay less for somebody at 30 than at somebody at 55. So you can bring somebody in at 30 and exit somebody at 55. You still have the same head count, but you might be pushing somebody out at 150 and bringing somebody in at 80. So right away you've got a delta of 70. You've just saved 70 grand. And you could argue that, we have a staff that is too heavy anyways, and given the rapid changes in the economy, and when I say rapid, I mean the shift, the heavy shift in the last little while to more and more digitization, that perhaps somebody 55 is not best positioned for how we should position the company over the next 10 years. The perspective of the 30-year-old might be more relevant for a changing world, with changing attitudes, with the changing ways in which we make payments, in which we interact with each other, in which we buy, in what we buy. So there could be that thinking. The other thing is, especially if you have the defined benefit plan, the payout of this person is based on what they would earn over the next 10 years if they hang out, and then that's indexed to inflation until they die, which could be years and years and years. So sometimes it is beneficial to pay them out now because you do save more longer term. You also reduce the present value of the benefit obligation because that person is no longer in there. They're gone. You probably score some delta on what it would cost you had you kept them versus getting rid of them now, except you are bringing forward all the payments or a significant payment to get rid of them now. So you can improve your income statement right away with the swap between these two, and your long-term outlook by eliminating this person from the fund. Even though the fund is not part of the company, the fund is separate from the company is still responsible for a fully funded pension plan. And then this person you may not have in the defined benefit plan. There may have to be a minimum of 5 years of tenure and a certain level in the executive level before they would qualify for defined benefit. So you'd replace a defined benefit person with a defined contribution. There's a whole bunch of good reasons you could make for that. Regardless, it is an empirical observation that I've seen. It seems to be there's a heightened use of the voluntary retirement across 10 Qs. So it's one of those things. Here's an empirical observation looking for a theory, right? Suppose that Powell would bring rates to zero to prevent further early retirements. Wouldn't a likely market rally and the wealth effect result in that group participants to retire regardless? Yeah, you're probably right. Search for yield would be that much more difficult, but the windfall that's invested could also garner some income for them, albeit not as much and definitely not as safe. Yeah, when I say run into the fire and drop rates to zero, it's one of those things that's simply just not going to be done. It's much like saying, Congress can easily pass a balanced budget to stop adding to the aggregate demand component from G in GDP, the G component in output, and massively increase immigration over the next 2 years to increase the labor supply, but that's not going to be done. So we can think of outcomes in response to strategic positioning by market participants, but in the end, those things won't be done, right? They're more thought experiments than anything. Let's see. Registered to take CFA level 1 on November at the same time. Would really like to take the applied series. Do you think it'll be extra help or it might be too much at the same time? Well, the applied series has no expiration. And I had somebody go on to Reddit. Whenever I do a video for exam results, I always have somebody go on to Reddit and get the tone. What are they saying? What are they talking about? What are the questions? How are they feeling about this? Let's get the tone so I know how to address, the cohort that just passed or did not pass. And more candidates this time, at least we picked up this trend, have indicated that they are more attached. They have been more attached to the market over the last little while, and it could be because it is front and center. It seems. And it is volatile, and it has been an interesting ride for the last couple of years. But in saying that, the conclusion, or at least the strain, the tone of the comment was that it helped them be a little bit more attached to the CFA stuff, and they could learn it better because they saw it actually happening, that they could actually apply something in the real world. So the note that I got listing all the stuff on Reddit also had in brackets, mention applied series on this, because there is a tone out there that says that it's there. So I seem to think that if you had the applied series and you were going through it, because it is very applied and it does apply a lot of the CFA concepts, it might give you a better understanding of what would otherwise be an abstract concept. So, in level 3, we talk about curve steepeners and curve flatteners and setting them up as duration neutral. And if you've never done it, it's an abstract concept. But in the applied series, we are actually going to do some curve steepeners and flatteners using treasuries. And we're going to actually set one up. We're going to see how we do it. and we're going to monitor it. Now, once you start doing it, then when you read it at level 3, you think, I've done this. I know exactly what's going on here. And it'll be more of a reminder of what you did as opposed to something new and abstract you've never seen. Is there a specific date for the price hike in the applied series? Sometime this fall. I just don't know when. It depends on how much I get done and how much I get up. And I've got a long list ahead of me of things that I want to get done. So content will be coming in the applied series every single week. 2 to 3 videos every single week. Sometime in the fall. So that would be, I'd probably say it's either going to be November 1st or December 1st. I'm just not entirely sure. Let's see, 2 questions. What do you think about gold? I have no opinion on gold. I have no opinion on gold. I think that, and I've said this before, that if gold was going to have its day is past. Gold is supposed to be a hedge against inflation and the devaluation of the dollar. Well, you had massive money printing and massive inflation, and gold did So, what's it for then? Like, if it was going to have its day, the gold bugs had always described this day as the day for gold. And the day came and gold went, So I don't even think the gold bugs really cared too much about gold at that point in time. How does a retail investor hedge with commodities? Commodities are a hedge against inflation. They don't really do much when inflation shows up because they've already inflated, right? So they're a hedge against inflation. I'm looking to get some broad commodity exposure for the long term, but unsure how to in the lowest cost way. I would say if you're looking for exposure, look for an ETF. This way here you don't have to pick winners and losers. You can look for an ETF that tracks a commodity index. In other words, it'll use futures and it'll have a balance of energy, ags, things like that, metals, or you can look for ETFs that track particular types of companies, whether it be mining companies, energy companies. Buy some ETFs across those. At least they have balance sheets and dividends and cash flows, right? So even if oil does go down, oil companies still continue to provide cash flow to shareholders. So there's a benefit there. Price of beef has been bonkers, and that December contract keeps rocketing upward. Yes, it does. On stepping into the pairs trade, would you ever consider stepping into one leg separately and the other later? Nope, because that's not a pairs trade anymore. That is speculation. I would not short one without being long the other because these are substitutes. They're economic substitutes. So the demand for beef, it would be equal to some intercept, some number minus some function of the price of beef plus some function of the price of pork. So that the higher the price of beef, the lower the demand for beef, and the lower the price of pork, the higher the demand for beef. The higher the price did I do that right? It is a plus, right? The substitute is a plus. I haven't done level 1 at micro for so long. I think it's a plus, so that the lower the price, let's see. Yeah, the lower the price of beef, the lower the demand. The lower the price of pork, the lower the demand for beef. That's it. Yeah, it is. It is a plus. A little brain fart there. I couldn't think it clearly. So because they are substitutes in that sense, the price of beef can only get so far out of line from the price of pork before consumers in the grocery store say, I can buy steak at, this price, or I could buy pork chops at this price, and it's, a quarter of the price. There will be substitution in the grocery store. Now, there'll be a segment of the population that is indifferent to price. There will always be that. But when you take the whole market as a whole, you push the price of beef up $1 higher than pork, there will be substitution at the margin. So the higher it goes, the more it will destroy demand in the grocery store. I'm still unconvinced that the hog backwardation and LE contango isn't meaningful for this trade. Just for those who are not quite sure what those things mean, backwardation looks like this, contango looks like this. So here's the front month on each contract, and here's your spot price. So in backwardation, the spot price is above the front month futures contract, and in contango, the spot price is below the front month. This usually just means tight supply and a high convenience yield, and this is not tight supply over here. And yeah, those things are meaningful. So we can look at, if you look at December, you look at the front month spread and you look at the December spread. Front month spread sitting at about 75 cents. The back month spread, the December spread, sitting at about $1.08 right now. So I think, we are really still at the beginning of the summer season. I mean, it is only July. I'd say maybe we're, call it 25% into the summer season, the barbecue season. These prices will weigh on the consumer as the summer drags on, and I think we'll see a shift. It is a mean reverting level. The 50-cent spread is a mean reverting level. If you look at the history of those two contracts, it does mean revert to 50 cents. So I am playing a mean reversion trade. That doesn't mean the spread can't widen. It can, but I have the fortitude and I have the patience to wait it out, and that's what I'm doing. Do you think we're a bit too early with your long duration trade? One of the things that I've noticed, and I'm not saying this to brag now, okay? You can go back over the last 2 years of my videos and you can look at my picks. I'm about 90% right. I have realized over time that my analysis is pretty good. I think things through carefully. I'm about 90% right on my picks. However, I am early to everything. I am early to everything because I'm looking at a chessboard, right? And I am playing, 4 or 5 moves ahead, and I say, aha, there's the trade. So if I have patience, the trade shows up. Whereas the rest of the market doesn't really, the crowd is not 4 or 5 moves ahead. I have to learn patience. Sometimes when I think of a trade and I think that's fantastic, I have to, in my head, say, but Mark, you're always early to the trade. Why don't you wait 2 weeks? Why don't you wait a month? Why don't you wait a little bit longer? But there's just something in me that can't do it because I say, but I can wait. I can wait it out. Plus, while I'm in the trade, being that I'm in the trade, there are other things I can do that I normally wouldn't do that generate income. Or they'll either lower my risk or they'll generate income. So I think it gives me a perfect excuse to start doing this other thing. So yes, I'm usually early to a trade, and unfortunately, I'm sometimes early to leave a trade for the same reason. So I'm early to the trade, and I'm sometimes early to leave the trade. So let's go back to the person who said, I'm uncertain whether or not I want to get involved in active management. I probably would be a far better analyst if I didn't invest money. Far better at what I do. And I would probably do a lot better if I gave my money to a good asset manager who then used my analysis. Because then that asset manager would say, well, it's just not the time yet. A good point. I think you're right. I think duration will pay, but just not now. Whereas I would do it right away. So probably what I need, like you got the Buffett Munger team. Maybe one of them is really good at picking and the other's really good at timing, right? So that's probably what I need is to combine myself with somebody who really has timing down, but doesn't have a lot of trade ideas. Whereas I can analyze very well. But you're right, I am early to my trades. That is one thing that I've noticed over time, is that I am early. Yes, you got me. Mea culpa. I guess lowering all the rates to zero is not going to work either, because it will further increase aggregate demand and inflation. Yeah, will get out of control. Yeah, Turkey tried that and did not work. Let's see. Would you answer know what people who retire at age 55? What do they do? It seems too young. Could work another 25 years at least. Yeah, it does seem young. It depends, I guess, on your outlook. It depends on your relationships. It depends on your family. It depends on a whole bunch of things. It depends, I think, sometimes on what you feel you've given up in life. It may depend on how fulfilled you are, where you find meaning. This is the wonderful thing about people is we are not identity groups. We are groups of individuals, all with different backstories, all with different likes and dislikes, which is one of the reasons why I'm so against this leftist idea of reducing people to their identities, because you can't do that. You simply can't. You miss all the richness of the individual. When you look at somebody, you say, aha, I see your gender, your skin pigmentation, I get an idea of your sexual orientation, I know enough about you. I think that is just, limiting the possibility of I guess I just don't have a poetic word for it, but I think you know what I'm saying. Who knows? I mean, some people at 55 find meaning in their work. To them, they are retired. That if you ask me when I will retire, I'll tell you, I retired years ago. I'm just following my passion right now. That if I were retired, this would be my hobby. I am living my hobby. So in essence, I kind of am retired. Given your point on voluntary retirements rising and the Fed having to keep on raising rates, if and when something in the market breaks and rates have to go down, these people see the yield on their retirement funds affected unless they lock in the rate. Yep. That would lead a lot of people having insufficient money for retirement. What do you think could happen in that situation? Well, I think the same thing that happens every time there's a drawdown in the market is wealth gets destroyed. Some people will be okay, and some people irreversibly will not be okay, especially if you're closer to 60 and you haven't balanced your portfolio for safety. Then yeah, I think that you could be irreversibly harmed with that. When you're young, growth is the thing. When you're in your mid-40s and pushing into 50, a balance of growth and income makes sense, and then you start thinking a little bit about safety. Once you get into your 50s, 53, 54, you're really thinking about safety and income. You're keeping a growth component, but it's certainly not the 80% growth component you had at 25 or 30. And then by the time you get to 65, you really should be pretty much safety and income, because you can't handle a drawdown at that point. So you want to be in securities with a good balance of risk factors, a good balance of these things. And for many people out there, that requires a professional to do. So I think that a lot of these people out there that are just your average, I'm going to call just average Joe and Josie, that listen to some TikTok videos or some YouTube videos, and they're buying the latest and greatest and the hottest, and they're trading on Robinhood, and they think they've got it all figured out because they rode a wave for a while. When that wave breaks, they will break very badly. What is it on Robinhood? Something like a little over 90% of all the pandemic accounts were wiped out, more than cut in half. So they will eventually lose. It's easy to feel like a genius in a bull market because everything goes up and you think you've got it all figured out until that wave breaks. So this wave now that we have will break, and some people will get hurt. Yes. What do I think could happen in that situation? Well, some people will unfortunately have life-changing events. The 30 was up 10 basis points, not one per your screen. Okay. Anyways, not sure if you were aware that the Fed futures chart, you can plot directly from the chart 1 week ago as well. Yeah, I know, but it wouldn't save me any time because I still write out the levels and the implied rate. So I can do that, but it wouldn't save me much time. A couple of questions regarding your long duration play. TLT had a pretty bad week as higher rates were priced in by the market. Yep. To which rate on the yield curve does TLT respond the most? 20 to 30. Is it the 20-year, or do shorter term rates also play a role? I don't think shorter term rates. You can look at TLT's holdings. I don't think they have like any 10 years in there. Do you see a scenario where the yield curve uninverts from a current position leading to capital market rates that are higher than the current money market rates? Well, as I said earlier, the way that would happen is inflation expectations become unanchored, and that the market simply just gets impatient with the Fed and says the Fed can't solve this problem, or the Fed is making a very critical mistake and inflation is getting away from them, and inflation expectations build into the long end of the curve. That would be the only way the capital market curve would create an upward sloping curve given elevated money market rates. I can't see that it would just do that on GDP growth. I just can't see that. If inflation is going away, you would need to have real GDP growth approaching 7-8% to get that. Those are not even China gets those growth rates anymore. Do you see a scenario where the yield curve uninverts? No, not really. How would you deal with your TLT position if a recession does not occur? Well, it has a yield, right? It has a yield. I'm okay holding it. It pays a monthly dividend. There is a withholding from the US because of that. However, if it is put to me, I would probably rotate into a synthetic. Although the synthetic costs me money, I'd probably do 3-month rolling synthetics to lower the cost of doing the synthetic. I certainly wouldn't do a 1 year because interest rates are so high. The options are centered around the forward price, not the current price. So I'd probably do 2-month, 3-month synthetics on that to avoid the withholding tax. But for the most part, I don't mind holding it. I do have US dollars in my trading account, so it's not like I'm worried about the currency exchange because I already have the US dollars anyways. I would hold it. I would hold it. I'd like to know your thoughts on evaluating the cost benefits of 2 to 5 day expiration strategies. Long iron corridor that expires July 12th. I'm not a big fan of these multiple leg strategies. Because you're playing a very specific outcome at that point, and you need that outcome. So I'm never really a big fan of these multiple leg strategies. I believe there's potential for hysteria to the upside or downside, provided a headline surprise or not. I believe core will once again be ignored. Probably. You know, the CPI days are volatile. You're right on that. They are volatile. But you want to put a trade like that on just before the report, which means you're putting it on at 5 to 4. If it's at 8:30 the next morning, then you can't really trade it till 9:30. So you could get a whole bunch of volatility right at 8:30 that then settles down. But the volatility, the implied volatility, would have been built into the options at 4 o'clock the night before in anticipation of that big report. And if it doesn't come out the way you expect, you get this big crush the next day, this big volatility crush that happens very quickly. And then you either have to get the move and it has to be sustained till 9:30 so you can get out, or you get nothing. It just, this is why I don't like these kind of trades at all. I prefer trades that do this. If the market goes up, what am I going to do? If the market goes down, what am I going to do? Great. I've got plans on both sides of that market. Now, let's see the report. And if the market goes up, well, okay, some things aren't going to work out, but some things come into focus that I want to get done. If the market goes down, well, okay, some other things don't work out, but some other things come into focus that I want to get done. So, I'm okay with either way. I try to find trades like that. So, I am going into this long duration short beta, and I added to my short beta today. I didn't add anything to long duration. Nothing. Oh, I did try to buy the March 2024 105 calls at a bid of 370, and never got it. That was the second or third day in a row now that I've been trying to buy them at 370. 365 last week, never got them. I was hoping to get them, never got them. 370, printed my bid, but never got them. It's a 50. I think it's almost a 30-cent spread, 370 to $4, and I thought, well, maybe somebody will throw out a 370 at me, but no, nothing happened. But I am looking to buy some of those calls. I believe there's potential for hysteria to the upside or downside, provided headline surprise up or down. For July for ES. Well, if you're doing ES, then that's okay, because with ES you can trade them at 831, 832. You can trade them right away. It's not SPY, it's not SPY, so that's fine. July 21st on September contract, you can grab July 12th. Okay. 1.5 above and below the current level, all in for 55 cents. 1.5%. It's a big move on S&P at these levels. 1.5 is a big day on S&P. For contract, about 60 for a 205 upside for a high risk day. That's basically chose strikes where IV smile most benefits the position. How would you evaluate whether this is too much to pay for the exposure? Well, the thing is, I don't do these kind of multi-leg trades. They don't turn me on really that much. I don't get that excited about them. I think it's just too much. The strategy is there, and you would use it for a specific outcome like you are using them. So you're using them in the right context. It's not my thing. I prefer single leg options to start, and then I step into strategies depending on what the market does. So the market will tell me what strategy is best for me to step into. I just simply start with an option, and then from there I move into something else rather than starting there. What do you think about covered call funds, given the uncertainty of the market being that the hype rally might continue? There are different types of covered call ETFs out there. There are some that do 50 delta and some do 30 delta. I think all of them cash settle the option. So they hold the underlying and they never sell the underlying, and they sell calls against it and simply cash settle them. So in a market that's going sideways or down, they really work out. In a market that's moving up, they simply lose. Well, I wouldn't say they lose, but they underperform. So if you think the market is going down, you can do better than just holding a portfolio and selling calls against them. So overall, I'm not really a big fan of them. It's worth noting if companies account for voluntary retirement costs as recurring or non-recurring. Well, they'd be seen as non-recurring, and that is sort of a benefit to the company, because in their mind, an analyst will pencil that out going forward, and will probably increase margins going forward because that cost is now gone. So it is almost all the way around. It's kind of a win for the company. If you are modeling financial statements and costs are listed as one-off, look and see how often the company uses that tool. Yeah, you're right. Companies often use the logic of we don't do it every year to treat it as a one-off, but they might do it every 5 years. Yeah, you're right on that. Active managers always say now is the perfect time for active management. Much like real estate agents always tell you, it's never been a better time to be a buyer. No matter what the hell is going on, it's never been a better time to be a buyer. The city's on fire. There's an invading army coming in. Never been a better time to be a buyer. I think it's just the first thing they learn in Real Estate Marketing 101. Is the idea of a market cap weighted index broken? NASDAQ seems to think so. It's rebalancing to reduce the concentration of the big seven, or the big, I think they're all in the NASDAQ, right? The big seven. There's a falling wedge into demand on mRNA. I don't know what that means. Had a question about an old video where you recommended looking at a company's lowest rated issued debt. I recommended it if I recommended doing it, it is for a particular reason. Having trouble finding this in the financial statements. Check 10Ks, didn't find any specifics on this. Where can we find this? Well, they'll usually have a debt schedule, and they'll list all of their debt securities. That's usually given to you in the statements. If you don't find it in the 10Q, look at the 10K. The 10K is far more detailed. And if you don't find it in the 10K, go to Investor Relations on their website and download their annual report. The annual report has even more stuff in it. So it'll be in one of those sources, but maybe not the Qs. You mentioned your performance has been roughly in line with S&P this year, and that you could have outperformed if not for some losses you took on index short positions. Which positions provide the most strength to your portfolio? Believe it or not, GM and Oxy. Just playing GM. Every time it drops down, I sell puts heavily, and it rises. When it dropped below 35, I was selling 35s, 34s, 33s, 32s, and where is it now? 39. Oxy, every time it gets below 58, I see that 57 handle pushing down to 57.50. I sell the 57.50 and 55 calls. I used to do them lightly, now I do them heavy. And I'm thinking I may as well move to 200 to 300 contracts each time now, because it just seems to hold its ground. Every couple of weeks, we find out that Warren Buffett bought more of it. So, you know what? I'm going to do some whale watching here and ride his coattails, and I'm going to say he's done his homework. He's done his homework. There's no need for me to do the homework. I'm perfectly okay selling puts on Oxy at 57.50 and 55. And when I did look at my performance and I looked at where my gains had come from, I was actually surprised how much I made from Oxy, because when you sell the puts, they disappear. So you don't have this running total that you can look at and see how much unrealized gain you have or unrealized loss. They simply just disappear. It's not until you look back you say, holy geez, I didn't know I had done this well on this one little guy. So I think I'm going to up my puts to the 200 to 300 range when I sell puts on them. And GM, if I see this thing go back under 55 again, I'm back in. I'm back in again. What impact, if any, would the resumption of student loan repayments have on the stock market? Well, I keep hearing, it's going to take demand out of the economy. But investment, we have an identity. Investment equals savings. So if there is money in student loans, that is an investment made by somebody. That was a loan made by somebody. That is somebody's savings. So, let's say that I owe you $20, or let's say the entire population owes you $20, and they haven't paid you for 3 years, but now in September, they're going to have to pay you. They're going to have to start paying you that $20 in September. You can argue that, well, that's going to take $20 of aggregate demand away from everybody in September. Yeah, but look how much aggregate demand potential you now have. You're getting all your cash. So when they make a payment, it's somebody else's return of capital or somebody else's interest income. So the money just doesn't disappear and dry away. It eventually goes to somebody. Somebody somewhere is holding some security of which they are now getting liquidation from. So the idea that it's going to pull all that money out of the economy, I don't think so, because that money's just going to go into other pockets, and it may find its way into the market in other securities, or it may find its way into the economy in real assets. So, I'm never too down on paying back debt, because when you pay it back, money leaves your pocket and goes into somebody else's pocket. It doesn't disappear. Do you follow Macro Voices podcast? No, I don't. Do you have an opinion on it, and do you recommend anything similar or better for in-depth macro analysis? No, I'm not familiar with Macro Voices at all. I don't find too much useful on YouTube, unfortunately. I have looked around, and it ends up being a lot of parabolic talking, and a lot of lazy statements being made that are not that are half truths, or statements made that I listen to and go, well, hang on now, that's not true. I think you want it to be true, and I think you want other people to believe that it's true, but that's not true. And that might be enough for the market, but for me, when I listen to it, I think, well, that's not true. I'm a little bit more, I guess, rigorous on that. And maybe to a fault, because maybe sometimes in the market you simply just need statements that are parabolic and people run with it. Maybe, right? Individuals near retirement being locked in 5 to 6% yields on their savings, haven't those same individuals probably experienced a drop in value? Okay, so this is another comment along the same lines. I think I've addressed that. Where can you find implied volatility percentiles? You find them in the, if you open up the options chain and you go to settings, you can actually put the percentiles in. If you have the applied series, when I go through the portfolio construction seminar, when I'm setting up the options chain, the window, when we first start looking at the options chains window and setting that up, I'll show you how. If you have the applied series and you have the options course, throughout the options course I use IB. I've probably already shown you how to add IV rank and IV percentile to the window. Can you explain your double premium strategy using options on short S&P futures? Yeah. So the curve, the futures curve, the term structure is upward sloping because interest rates are higher than the dividend right now. So you have a spot, let's say it's 4,400 on SPX. The December contract is probably 4,490. So you have 90 points. So if you're short, you got 90 points of carry. And options are centered on here. So that means if I sell a call, I'm selling it at 44.90. The call is on the futures price, not the spot price. So if I sell a call at 44.90 for, let's say, September expiration, I might get 100 points, which means 45.90. The index would have to get to 45.90 for me to lose anything by the expiration date of that. So it gives me that extra carry because of where the options are centered. They're not based on the index, they're based on the futures, and the futures already have carry because the interest rate is so high. So if you're looking at the September expiration, how far away is that? 66 days. So that's a money market rate for 66 days. That rate exceeds, because it's so high, it exceeds the dividend yield. Both expressed, whether you express them on a compounded basis or a continuously compounded basis, you're still going to end up with contango on those futures. Do you use hidden orders for options? No, I don't use hidden orders. I'll if I need to sell something and I don't want to print something, I'll use smaller orders, and just many of them. So I don't, I'll put limit orders of 200, 300, and I'll cluster them in maybe a 7 or 8 cent spread somewhere if I want to get something. Or I'll use a combination of calls if I want to sell in the money calls, or in the money puts if I want to buy, along with buying itself. If I think it's going to be a problem, if I print something that I don't want to print. You try to avoid stocks where you have to do that on the way in, because if you have to get out, you're going to have the same problem on the way out. If it takes you 4 days to get into a position, it's going to take you 4 days to get out. And if the market is moving fast, you're not getting out without significant cost to getting out. So you try to avoid, part of risk management, is the upfront risk management, is avoiding securities in which risk management would be difficult to conduct. I think you would use it for illiquid stocks like ABR versus that of SPY. Not really. No. Portfolio construction course. Would the setup and instructions be readily applicable to Oh, I already answered that. Just you'd have it. It's not so much. I'm not teaching you how to use IBKR or Trader Workstation. I'm just using it. It's just a tool that I'll be using. The parallels of it, trade the options, access to forex, access to futures. As long as your platform has access to different securities, you're good. You don't actually have to have the same screens that I have. Some pundits argue that in this environment of accumulated excess cash, high interest rates might be in fact inflationary because they provide a strong yield return which can be looped back into spending or investing, thus reinforcing the inflationary forces. Again, take early retirees who then decide that to take the commuted value of their pension and lock it into bonds that have a collective yield of, let's say, 5.5%, but a coupon of maybe 3%, 3.5%, let's say. Well, they're going to be taking that money out. That's going to be the income that they're taking out of their portfolio and spending. If interest rates were lower and they retired, they would have lower interest to take out, but they would be taking out more of their capital. So you'd have to make the case that because of higher rates that actually spend more money. I don't think that that's the case. I think with higher rates, they're less likely to use their capital and more likely just to rely on the income from the portfolio. But I don't think that they would say, well, we can spend 150 a year now instead of 100 a year. I think they'd still stick to their plan, but just let the portfolio continue to grow. In other words, not really touch their capital. Lynn Alden wrote in her latest newsletter that this inflationary cycle is more akin to the 40s than the 70s because of the accelerated growth in money supply we've seen in the last 3 years originates from high fiscal spending as opposed to high bank lending. In this case, she argues the Fed's rate hikes might not be the right tool to fight inflation because while they're effective to discourage bank lending, they're not so effective to discourage fiscal spending. Well, I don't know that you need to go back to the 40s to make that argument. You simply just have to look at the last, 20 years, 25 years, 30 years. Actually, no, sorry, Clinton. Got to give credit where credit is due. Clinton had a budget surplus. Since then, it's been budget deficits. Spend. And it is, and same in Canada, spend. Because why should I campaign for votes if I'm in power? I have the budget. That's my re-election fund. I can buy votes. And the Trudeau government has done that to perfection. They buy votes like you wouldn't believe. They release a budget and they say, you get money, and you get money, and you get money. If we're re-elected, this will be our budget. So you think, well, I'm going to vote for them because I'm going to get stuff. And it's deficit spending as far as the eye can see. And in the last press conference, Powell did speak up about this when he was asked about the fiscal side. Was it in the press conference? Or no, it was. I think it was in the. Well, it was either the press conference or on the European tour he was on, where he did say, the spending isn't helpful. He didn't comment on anything fiscal. He's not going to, but he said, on the whole, it is not helpful. And at some point, there has to be some rationality that steps in at somewhere and says, look, man, we can't keep doing this. We can't keep spending like this. Inflation Reduction Act. I mean, just because you say it doesn't make it true, for Christ's sake. You spend $1.something trillion and you say, we'll reduce inflation by spending almost $2 trillion. You'll see. Like, come on, man. But I think, given the heavy reliance on democratic governments to use the budget to now buy as many votes as they can for the next election cycle, there is no end in sight to this, and I think the interest rate is less effective than it could be. I understand you have a long-term view on copper. What about lithium producers? BHP, I think, just announced that it was doing something in lithium. The big guys will step into lithium, but pure lithium plays right now are super expensive. The hype is priced in there, so I'm not going to touch them. What do you think about semiconductors? Never bothered with them. I know I'm missing a big sector there, but it's not my thing. I don't have expertise in it, and I have a rule: if I don't understand something, I don't touch it. According to Powell, I'm looking at the time here. I'm going to have to wrap up here soon. According to Powell, the neutral on interest rates ought to be 50 basis points higher than the inflation rate for the entire yield curve, with core inflation ranging between 4 to 5%. Yes, we have to traverse the biggest base effect number this month, but odds our inflation will reaccelerate on August 10th print. Shouldn't the 10 to 30 year trade at a premium if the neutral rate is at 4.5? I don't know if I would go that far out on the curve. Could it be argued that the long end has been suppressed mainly due to a shortage of collateral and negative term premium rather than recession pricing? Well, the long end, the further out you go on the curve, the more it's going to reflect long-term real GDP growth and inflation expectations. So if inflation expectations are well anchored around 2% and long-term GDP growth is somewhere between 1.8 and 2%, you should be 3.8 to 4%. And I think that's where the 30 year is hanging out now. So I don't know that I don't know that I would go further than that. TGA has opted to refill mainly by issuing bills. Issuing bills takes pressure off the reverse repo, but it's rolling over $1 trillion worth of bills every month. Oh, okay, so that's hyperbolic there. Is that really the best approach? If you believe that rates are going to be dropping, if you believe that, you know what, I think what the Fed is doing is going to break something and we are going to have a recession and we have lower rates in the next 6 to 12 months, we're going to have much lower rates, then issuing short-term debt makes a lot more sense, as opposed to issuing 10-year debt at 4% and only to find out in a year that 10-year debt is 2.25, right? Well, now you got to live with that for 10 years. So, banks do this as well when there's a view, when the ALM group has a view on interest rates and they believe that, well, interest rates are high but are dropping, they'll rely more on short-term funding now because that short-term funding will drop because it's short-term. As opposed to locking in anything long-term, they'll rely more on short-term funding. Even though it may not be the best thing today, it will be the best thing over the next several years to rely on that today and then lock in lower, longer-term rates when you get there. So maybe Treasury knows something, right? With additional net financial requirements this year and next, it seems likely we will have to release some duration into the market. They will. But I think they're probably filling the short end of the curve right now and probably slowly moving outwards. Not much of a demand for like the 5s, the 7s. Once you get into capital markets, the 2, the 5, the 7, those are big tenors. The 3s, the 7s, the 20s, they're there, but they're not really a big thing. Do you think the Fed has what it takes to step on it again and really destroy aggregate demand and weaken the labor market? That's all they can do. And that's their job. That's all they can do. Can one use risk-neutral probability equations to value options similar to what is taught in CFA Level 1 derivatives? Well, all options are based on risk-neutral probabilities. All of them. So, yeah, exactly. Seeing the difference between the as-reported S&P forward earnings multiple and the operating earnings multiple makes me wonder about how one should analyze companies that always make adjustments to net income. Usually those adjustments, they're difficult to forecast, so you usually forecast them at zero. And they're usually unique, maybe one-off. If they are recurring over time, then you might have some percentage of EBIT that might represent these sort of things, but usually you wouldn't forecast out unusual events. IB has an option to set initial capital of paper portfolio. What value should we use for starting? 1 million. 1 million. I'm currently going through an economic textbook which states interest rates and bond prices are inversely correlated. That is a fact, which is more or less true. No, it is not more or less true. It is a fact. Period. It is a fact. And I can prove it. Let's take a timeline, and let's take $100, and let's take a present value, and let's say it's a zero coupon bond, and this works for all bonds. Discounted at 5%, discounted at 6%, discounted at 7%, you'll see the price drop. It is a fact. It is just the time value of money. It is not more or less true. It is just a fact. Looking at the data. But it isn't true for 1 and 6 month treasury bills. Yes, it is. Yes, it is. It is a basic mathematical fact. And I think I have replied to that, yeah. What is the level of prerequisite knowledge someone needs to subscribe to the Applied Options series and the Portfolio Construction course? Well, I don't think that you need any prerequisite knowledge other than, do you know what stocks are? Do you know what options are? And are you willing to learn? Do you have a curiosity? Is this a game you like to play? If it is, then you're good. The point about it is that I show you how I do things, and I show you how you would structure certain types of trades to take advantage of certain things, depending on what your forecast is, and that's all. So it doesn't require you to have the CFA knowledge, and then I just start talking to you like you have that CFA knowledge. Isn't the general rule for retirees 4% withdrawal rate that grows with inflation? Only if you're taking only if you've retired and you are taking from your pension. If you are drawing from it, I think it's 5% per year that you must take out. But you more than likely have a taxable account as well and a tax-free account. A 5% bond portfolio you mentioned would not grow, so in 30 years would be eroded by inflation. Well, if you're getting a 4% 30-year yield, let's say you put it all in the 4% 30-year yield, if you expect that the average level of inflation over the next 30 years is going to be 4%, then yeah, you have no growth in your purchasing power. You have stable purchasing power. But if you think that growth will be lower, you will have an increase in purchasing power. But the idea behind portfolio distribution, when you're in distribution mode, is that your capital base will decrease each year. As you grow older, you will be taking some income and some capital, right? Would you recommend as a good resource report for high yield spread by industry? Might be interesting to drill under the surface when spreads start to expand. I don't know. I'm not really a credit investor. I think that you could probably just Google that and start to get one source that then leads you to another source, then to another source. While I understand that bank runs have created a wild contagion effect, I honestly wonder if that SVB shock would have been enough to cure inflation by scaring the consumer enough to slow spending. Given the past 3 months of tech momentum, yeah, I don't even think we talk about it anymore. You have to keep reminding people. Do you remember? Yeah, 2 big banks failed. You remember that? It's like whatever. I think everyone has sort of come to the conclusion that it was those specific banks that failed because of the management or the practices of those specific banks. Also, I wonder how a ban on cruises, bingos, and make-your-own wine kits would affect boomer service. Perhaps we would need to run into the fire if targeted policy worked. You can't ban bingo. Bingo, at least in Canada, bingo, I don't know about all of Canada, but in Ontario, bingo is run for charities. that you have to, there's a bingo hall, but the bingo hall can't run a bingo. A charity runs the bingo. They just rent out the bingo hall and there's a revenue share, but the charity runs the bingo. Make your own wine kits. Well, ugh. Ugh. If the effects of the hikes of the past 9 to 12 months are yet to be felt, this should also apply to inflation. We need to inspect the effects of current monetary policy in around 10 months. Well, yeah, you could say that. If the interest rate effects haven't been felt, then its effect on inflation hasn't been felt. Yeah, I think that's a point. But don't you think that would lead to a boost? Okay, we've already talked about I think we've mentioned the Fed, the retirement issue a couple of times. You're making the same point somebody else did as well. Here we go again, making the same argument, which is good. I mean, we had some good thoughts on that. I'll take a couple more and then I gotta stop here. If I buy only portfolio construction section, would that give me credits to then buy the whole package? Yes, it would. If instead of breaking the economy, as per your discussion on boomers retiring, the Fed drops rates to zero, wouldn't that result in an asset boom? Yeah, we've already answered that. If real yields are going up, which increases the denominator in valuation of equities, how does it impact the equity index? Will it go down? It should. But you can always make the argument, sure, the real yield is going up and that is impacting the discount rate, but cash flows are going up even more. Let's not forget there's a numerator. The economy's on fire. Everything is great. We're going off to new highs. That numerator is increasing faster than the discount rate. So you can always make that argument as well. Anyways, I think we got some more questions to go here. We got quite a few coming up, but I'm out of time, and we will leave it here.